I am actually very truly excited about this for three primary reasons. One, as an incoming CEO, one of the things that could have hampered me is the negative energies that could have gone in setting things right. I do believe that it's a great foundation that is there in the platform, and it gives me an opportunity to spend positive energies in building the platform from here. So that's one reason that I am truly excited. The second is, of course, as you saw, every area that we touched, every product area, every segment we touched, there are clearly identifiable levers that can drive the next phase of growth for the bank. And as you saw, went through the presentation, every area Shalini or Harsh touched, we have been able to identify future levers of growth on each of those areas. So that again gives me an optimism that we can make a difference to each of those areas. And third, but last but not the least, I think the pride I have felt in our people of being federal is just amazing, and the team quality is fantastic, and I think it gives me a great base for powering the future. I think all three reasons keep me extremely excited, and as I said, good teams is what are required for good execution going forward, and we are fairly confident we'll be able to make a difference to the way we execute going forward. Thank you.
Can we have the QR codes back on the screen? Yes. So the house is still packed, so that shows the interest in the bank. Thank you. It's a Friday evening, but thanks for staying back. We have 19 questions, and we have put back the QR code again. But of course, we would also like to return home early. So yeah, let's keep it precise. So I'll read out the questions. Manin sir is here. He is going to answer all of them. Here's the first one. What is the balance sheet growth expectation over the next 3 years?
Venkat did make a mention of this in his presentation, right? So we are assuming that we will continue to benchmark around 1.5 times the nominal GDP growth rate is the kind of guidance I would give. If the environment is much better and we get better, we'll see. But broadly, that is the range you should assume. Yeah.
Second question, how will the margin move in the next 12 months, assuming a 50 bips additional repo rate cut?
The math is, yeah, of course, there will be short-term pressures on margins as repo rates fall and deposit rates do not. Venkat did again mention that the fall in deposit rates could be slower than the repo rates. And we do expect, therefore, some short-term pressures. But remember one thing that I just want to repeat that. The arrows and the numbers we put there, as I clarified earlier, those numbers are not important, right? And the entire industry benchmarks could change. When we said best 3 and next 3, the best 3 numbers could be different, next 3 numbers could be different. The idea we were trying to convey was that we will like to fall in the middle of the pack there among the 6. And of course, whole thing may be elevated, whole thing may be moving downwards, but the idea is to see where we will lie ballpark. Exact numbers, we are not giving here exact guidance on where the NIMs will be or where each of those matrices will be. But having said that, this plan is a medium-term plan, and as Venkat mentioned, we remain medium-term positive. Short-term pressures, yes, there will be some short-term pressures, but we will navigate them as they happen.
Sure, sir. Next question. What are the key milestones and priorities for the bank?
So we talked about most of them through the presentations. I'm sure there was enough guidance on that.
So we move on. On slide 20, you show an aspiration to improve the KASA ratio from 30% to 36%. Given the limited KASA growth in the industry and most banks showing negative trends, Why do you think you can succeed?
So like I said, I did mention this, right? Our key difference is in car. And we believe that we have not exploited the car opportunity even within our current network. Even in Kerala, we believe that the car opportunity is more than we have exploited. So I think just the right focus and right execution is what is going to, 4 out of that 6%, as I mentioned, has to come from car. And let me just give you a sense of, even over the last 3 months, we have been able to make dramatic difference to new car sourcing. And the teams have really rallied around to making that happen. So the fact is we are already seeing signs of car. And like Harsh mentioned in his presentation, the SME side, commercial banking, BUB side, there is car potential in each of them. And we believe that there is opportunity even within what we do to enhance that. And I think it's purely, the reason we will succeed is purely better execution.
Next question, sir. In the ROA progression chart, the credit cost increase appears higher than the increase in the yield on advances. Does this make sense in terms of NIM expansion, or is it a graphical misrepresentation?
Yes. So it's not exactly to the scale. The point we were trying to make there was not exactly, those were not exactly to the scale, but the point we were trying to convey there was that our ROA expansion will be driven more by liability side, then by fee side, then by yield on assets, and to some extent that yield of assets will be taken away by the credit cost. Obviously, we will not, we talked about RAROC and we talked about risk-adjusted returns. We will obviously make sure that the increase in yield is not eaten away completely by credit cost. That was more a graphical representation. My apologies if the bar looked slightly larger than it should have looked, yes.
Next question, sir. Growth trajectory near to medium term.
I go by the same guidance, 1.5 times nominal growth rate. Like I said, short-term pressures will be there. It does look like there will be short-term pressures. But again, if we are on a strategy discussion, we should be talking 3 to 5 years, and we remain reasonably confident of, on an average, getting those kind of 1.5 times nominal GDP rates. Yeah.
Sure, sir. Approach to taking higher initial costs. How should we think about the near-term reset?
No, like I did mention that yes, there will be some areas where we'll take higher costs, but you also saw focus on taking activities, centralizing them, trying to get cost efficiencies. Of course, we are trying to balance multiple objectives at the same time. There will be some balancing of, we will try to, you did see some cost rationalization measures that we are thinking about. Our effort will be, of course, to find cost rationalizations which we can invest back. But having said that, investing is important. That's why I showed very little gain out of cost in the ROA gain, right? That was, so we will obviously try and keep it somewhere there by trying to get efficiencies to pay for the investments we make. We'll try and balance it as much as possible. Yeah.
Next question, capital planning. What is the bank's strategy?
Just now, if I take into account this year's profits, which we have not yet built into the capital adequacy numbers, if we build in that, we will hover around a 16% capital adequacy, Venkat, 16.5% capital adequacy. So just now, no plans for capital raise.
Sure, sir. Next question. What will be the average loan growth in the medium term?
Same, I think we have answered that question.
Sort of repeat.
Yeah.
When do you see deposit pressure easing for the system?
Anybody's guess, but you know, it depends on a lot of things. I think the currently with the capital market state, FII flows out, and you know, the current state of liquidity where the system is still running significant deficits, yes, I think the deposit pressures will continue for a while. But you know, I often say that for a bank which is 1.3% market share, I think we should worry about wresting market share more than the overall system. I think the bigger banks who have 20% and 10% and 12% market share should worry about the secular growth of the market. I think we should remain focused on wresting market share and growing ourselves rather than worrying about what is happening to the overall deposit growth in the economy.
A big one, sir. Competition has increased sharply in the MSME space, especially after the RBI's restriction on unsecured lending, which was previously driving growth. MSME credit costs remain low, but concerns about irrational pricing are emerging. How do you view this segment from a margin perspective?
Yeah, so I agree with that. I agree with the fact that there is some level of irrational pricing that is happening on focus segments. It happened in home loan. Now this is getting to MSME as well. The only thing I would say about MSME is while yes, loan pricing is getting tighter, the good part is the wallet share in this business can be very good, and if you choose your customers properly, if you have a focused strategy about the kind of customers you choose, you can still make customer level profitability, and there can be strategies beyond just loan pricing which happens in a product like home loan, where any amount of revenue you make from the customer can never make up for a large home loan. Underpriced home loan, you can never make up for it. It doesn't happen like that in an MSME kind of a business. So I remain, yes, pricing is getting tighter, but I think it is still possible to play that segment with some, if you play that intelligently, I think it is still ROE accretive segment.
Okay. The problem is the questions are still trickling in. Okay. What if the bank's historic strength in dollar deposits reverses?
No, actually, to get it right, let me, in the NR segment, our largest market share comes out of our NRE deposits, followed by NRO deposits, and then followed by FCNRB. FCNRB, we have often found, is quite irrationally priced, and we have never been a large player in the FCNRB market. While we do have a base, but our market share of the FCNRB, the dollar part of the NRI business, is relatively smaller, and we don't think it is really it is the relatively lower profitable segment of the NR business for us, and it's highly price sensitive. It's and like I said, a lot of irrational pricing happens from very large banks sometimes. We are not that, our strategy is not revolving around the dollar deposits with NRIs. FCNRB is not part of our core strategy.
Okay. Next question, sir. Your branch strategy highlights a focus on metros while also emphasizing mid-tier markets. Given that metros are highly competitive and saturated, while tier 2 and tier 3 cities have high savings and greater wealth generation opportunities, how do you plan to differentiate and capture KASA and wealth management opportunities in metros?
No, so if you saw our strategy, it is a balanced strategy. We do want to focus on tier 2, tier 3. But having said that, the reality of the market is the top 8-10 markets are so overwhelmingly large. In the sense, the 30th branch in Bombay will still be bigger than the first branch in, or the third branch in some tier 2 cities. That's the reality of the deposit market. And therefore, it's also a large market. Yes, competition is higher, but it is also a very large market. So we have to play this game reasonably intelligently. That's why I said in metros we want to go pin code level, right? At pin code level, so you have to pick and choose your battles carefully in the metro market. It is possible to do, and pick and choose tier 2, tier 3 cities which are fast growing. And there is clearly, it is easily possible to identify those and pick. So we'll play both games in a measured manner. The cost structures in the metro markets are always much higher than, let's say, tier 2, tier 3 markets. So you have to be conscious about multiple parameters when we choose our battles in each of these segments. But I'm reasonably sure we'll be able to apply ourselves intelligently to the challenge.
Moving on to the next question, sir. Exactly 10 years ago, Kotak acquired ING Vysya. Given your M&A experience and the reasonable valuations in the banking space today, does an inorganic growth route make sense for the bank? reasonable valuations?
There's nothing on the plate just now. In the future, should we be looking at it? Of course, we should be looking at it. Having said that, inorganic doesn't happen. You need some serendipity for it to happen many times. It doesn't happen just because you want something there. It's also important to build your currency well before you get into the inorganic mode, right? So I think there is scope to build our currency in the short term and then look for inorganic. Of course, over 3 to 5 years, should we? Of course, maybe we should.
Okay. The bank is focusing on the mid-market corporate segment. How does the risk-adjusted return in this segment compare to the large corporates? What is your targeted market share over the next 3 years?
So, corporate is not a market share game. It is in my mind, it is very ROE sensitive, wallet share sensitive kind of a play that we must make. We must make a profitable model there in corporate bank. That's very important. It is easy to build market share in corporate, right? You write a large check at a very poor price, you can build market share. So clearly, corporate is not a game to play on market share and price. Because having said that, in the mid-market, the reason we are more bullish about the mid-market part of it is, Harsh did mention it in his session. The reciprocity is much better in the mid-market than at the large market. In the large market space, RBI has the 10% rule, right, for transaction banking. If you are not, it's more difficult to get to 10% of the share in large corporate than it is in the mid-market segment. So in the mid-market segment, it is easier for us to gain 10% of the lending share in that corporate, and therefore demand for much more reciprocity of the more profitable business. So that's the reason it is relatively more easy to make that business profitable and ROE accretive than in the larger corporates. And that's the reason we want to focus on that.
Quite a big one. In the initial slides, you discussed the need for higher upfront investments to gain better profits later. However, the bank has traditionally followed a low initial investment approach, leading to lower fee income. Meanwhile, in the fee enhancement slide, product coordination is highlighted as a strategy. Could you clarify which business/fees would be brought fully within the bank and which will remain under co-origination?
No. By co-origination, I did not mean outside the bank. By co-origination, I meant, example of co-origination, I thought I mentioned it. When we source a savings account in a corporate, it's possible to source a credit card along with that, or an SIP transaction along with sourcing a credit card, or maybe a small insurance along with that. So co-origination is about creating more efficiency in sourcing multiple products, improving product per customer, and therefore making more fees out of some of those transactions. So that is what I meant by co-origination. I didn't mean outside, inside. Having said that, your point about the approach, I did say that we will modulate our approach on where we want to invest more in the beginning for a higher gain later. I did mention that we will change our proportion of digital sourcing in credit cards, which will mean higher costs in the beginning, sourcing costs in the beginning, but it will give us better revenue control of that customer going forward. So there will be, we will do selective, we will select carefully and make sure that some of these products we may take upfront investment for higher benefit in the future.
Something on origination mix again. For NIM expansion, liabilities were mentioned as a key driver. However, reducing the cost of deposits is much harder than improving lending yields through changes in the origination mix. Why not focus more on improving credit origination filters to generate better yielding products and use them as NIM expansion drivers?
No, it is not one or the other, right? We did say that we want to expand NIMs through assets as well. It is not that we don't want to expand NIMs through improved yields on the asset side. And we also said that short-term environment may not be friendly for adding the higher yield products just now. We would wait to get air cleared about the credit costs on those kind of products. Having said that, in the medium term, we have built growth in that side of the balance sheet as well. But like I mentioned, the core DNA of the firm is relatively lower risk on the credit side. Credit is the easier part to scale up. Credit risk is the easier part of it to scale up. If we feel confident and the environment gets easy and friendlier, we will remain very alert and astute and agile to make sure that we make use of that opportunity. So it's not that we are saying no increase in yields through assets. We will target both. But like I said, I see an opportunity because our current account is significantly lower than the six peers that we have picked up for this analysis. And therefore, I see bigger opportunity to do that, and that can have a significant impact on our cost of funds. That's the reason our benefit in ROA from cost of fund side is looking higher than the asset side. Yeah.
Next question, sir. The bank is often perceived as risk averse. With the introduction of the new RAROC framework, why not drive NIM expansion through asset side initiatives rather than liability side strategies, given that asset origination is generally easier than liability origination?
We answered that. Same question.
So, while I was there, I was getting constant texts that when will Q&A start? Now I know why. Okay. Just give me a second. Right. Next question. In terms of priority, putting cost ahead is easier. Take us through how you're looking at ROA improvement argument, as it is easier to put costs but harder to get productivity out.
Yeah, obviously. I agree with that statement. Having said that, I think, like I said, we have to be careful about what costs we put, and as in tandem with increased productivity and outcomes that we expect. So we are hoping that we will execute well to make sure that these go in tandem and we actually expand ROAs. Otherwise, of course, it doesn't make sense to put in costs without visibility of productivity out of that.
Along with the tech focus, could you guide on branch...
Not all productivity increase needs to come by increased cost, right? There are things we are doing here where we are expecting productivity to come without adding additional cost through better focus, better products, better alignment and all that, right? So there are things we are going to do which are going to yield some improvement without necessarily adding costs, which of course we'll prioritize.
Along with the tech focus, could you guide on branch expansion plan as peers' branch count is higher?
Yeah, like I said, we are looking at 400 to 450 branches, which is generally higher than the run rates we have done in the past. I would say just now, sitting where we are, I would wait for productivity gains and the model proof to play out before we get more aggressive with that. I think this is somewhat aggressive, but not very aggressive. Like I said, there is a lot we can do with existing network. Like I said, our existing network, KASA per branch or KA per branch or deposits per branch is lower. We need to push for higher productivity out of that. As we get demonstration of the model working well, we can get more aggressive.
Most of the capabilities you discussed to bring for the future growth and ROA improvement is more expected to deliver from FY27 onwards?
Not necessarily. Hopefully it will start delivering as we go along. Not everything will be with a lag of 2 years. I'm sure we'll start seeing delivery on some of these earlier than that.
While ROA is likely to move up by 25%, okay, right, okay. By your effort, we have to double up work as analysts to give 50% more in PVB. But can you explain why ROE should go up by 10%?
I'm not getting into what analysts should do and they should do what they should do. All we have to as a team make sure is that we expand ROA and that results in ROE expansion. We are somewhere in the middle of the pack there on the ROE side. We want to get to the right end of that graph, right? And that is our aspiration. The aspiration has to be realized through better execution. That will, of course, we will remain focused. Analysts and investors do what they do. We will continue to do what we do.
The top 4 private banks all have strong subsidiaries in insurance, capital markets, AMC, and broking. Federal does not have any. Any aspirations to expand these businesses as it would help the deposit franchise as well? You mentioned scaling up capital markets and wealth management multiple times. Will this be organic or inorganic?
So first, of course, my theme 12 was journey towards universal bank, and we said we will move towards that. So yes, I do recognize that the top 4-5 banks are universal banks, and if we want to be in that peer set over a period of time and aim to get there, we also need to build that model over a period of time. This can get organic or inorganic. Again, that I said in the my chart as well. We will figure our way around whether organic or inorganic happens, but we are clear that is the journey. How will depend on situations, opportunities that happen through the next few years.
In the next 3 years, based on analyst expectation, top 3 banks will see around 15 to 16% ROE. Based on your presentation, you intend to be closer to top 3 banks' ROE, implying 1.4 to 1.5% ROA at 10x leverage. Is that correct interpretation based on graphical representation? Yes.
I will leave the interpretation to you, but having said that, yes, we want to get to somewhere close. See, there are 2 aspects to it. One is the size aspect, one is the ROE aspect. We are not saying we will become size-wise the same as the top 3 banks, but there is no reason for us to say that even at a lower size, we cannot produce similar ROEs as them. So that should be the logic.
Earlier, Federal Bank maintained that they want to be customers' favorite bank and growth was moderate. How has that changed now?
Come again?
Earlier, Federal Bank maintained that they want to be customers' favorite bank and growth was moderate. How has that changed now?
We want to be the customer's favorite bank and investors' favorite bank.
Nice one, sir. Okay. Questions are still pouring in, sir. We'll continue.
Few more you can take. Are there questions coming on Shalini and
I have.
Harsh portion of the? So let them come here and.
As you say, sir. Anything from the regulator regarding investments in subsidiary with similar line of business?
So it's an open issue. Of course, all of you know the draft circular that was issued, and after that, all the banks who were affected have made representations. I would say we are still waiting for the final response on that. I think there is some amount of discussion that is going on at the regulators end. We will know when. Just now we have no further news after we made our representation on that. So that's where the matter stays just now.
In the initial slides, aspiration was top private bank. Currently, I would name the bank, X Bank, which is the 5th largest bank, is 40% plus on assets and profits. Can it take more than 5 years to reach that milestone, or you can accelerate growth to 2 or 2.5x nominal GDP?
Like I said, I think it's not necessary to be the same size, right? As long as we are treated in the peer set, even in that peer set, the size differences are significant, right? So I think we should not be prisoner of our own imagination on the size part of it. I think it's important to have the right quality of earnings, right matrices, which place you in that qualitatively rather than quantitatively.
What is the status on embargo on co-lending cards? What is the bank doing for the same, and when will the embargo be lifted?
Like Shalini mentioned that in a limited manner with one partner we have started issuing cards. We have restarted the process, and as other partners fall in line with the requirements for the same, we will progressively restart those other partners as well.
What gives you confidence about stable cost ratios despite investments in talent, branches, and high-cost products?
Like I mentioned this earlier, right? We are assuming that there are certain initiatives which will give us revenue upsides without necessarily increasing our costs. There are definitely initiatives of that kind, which will higher productivity and things like that will also pay for the costs. And we have to calibrate our incurring costs in a manner that we keep those ratios intact or around the same ballpark. Yeah.
Next question, 2 parts on NIM. Federal Bank is a leader in NRI deposits and yet has the highest interest rates. Can the bank cut rates and maintain its share? Is the problem in lending yields from retail or corporate, or is it a customer segment selection problem where low risk implies low yields?
No, so first, our NRI deposits are not particularly high or anything like that. That's not true. That franchise is not price-led franchise in any case. Like I said, the price-led portion of that franchise, which is FCNRB, we do not play that game too much. So it's not a price-led franchise on the NR side. On your pricing side, we did have a lot of discourse today around how we want to be more scientific about pricing, how we want to be more look at the customer value rather than just product value in some cases. So yeah, there is work to do, and we do want to make sure that our pricing gets more scientific and it is based on risks. It pays for the risks we take.
Your strategies suggest approx 40% CAR deposit CAGR growth in next 3 years. Which are the 2 big initiatives which can give this outcome from all the strategies discussed?
CAR?
Yes, sir.
There are multiple things there we talked about, right? Higher focus on the SME segment will lead to better CAR. Just the sourcing side focus of branches on CAR can lead to that. There is capital market linkage we talked about there, which will lead to CAR. There are multiple things we talked about there, right? Which will lead to improvement in CAR outcomes. 40 or not is a separate issue, but definitely growth of CAR. Yeah, we are also starting from a low base on CAR, as I said, and low share of the market. So we will look for and products. We talked about separate products. Shalini did mention about the Soundbox product we launched a few months back, where we have focused on that offering. CMS, we talked about cash management services in Harsh's presentation. There are multiple initiatives that can drive CAR.
Thoughts on acquisition?
Yeah, thoughts. Yes, we are thinking about them.
Are we late to the party to grow our unsecured lending? We were a bit slow to grow our unsecured book when the industry identified growth. We are trying to grow now when the industry is seeing risk. So are we identifying this trend? We are getting late to the next party,
no,
sir. Too many questions.
No, currently we are not growing our unsecured book. If you see our unsecured book, it is not growing, and we see the risk in the environment. Having said that, it can't be late, right? It's not that the whole of the market has been exploited and occupied by current players. I think there is still scope for, if we want to grow, there is still opportunity to grow. But as I said, we will push the pedal on the unsecured side after we get some more comfort on the credit environment on that side.
Top 3
and I don't see a problem with being late to the party there.
Top 3 priorities from the 12 themes discussed.
That is like having to choose amongst your babies. But having said that, all the 12 are very important. Having said that, if one thing that we have to get right is the KASA and NIM are the 2 things that we would like to get right. The biggest priority, and third, of course, if I have 3 you ask, is fee. So if I am asked three things to really prioritize: KASA, NIM, and fees are the three.
So I think Venkat sir answered this while he was here. What are some non-negotiable KRAs for the top management executives? And if you could talk about the same for the branch heads across geographies.
Let's, no, obviously, the three priorities are the three priorities for top management, of course. So that should be non-negotiable. But more importantly, I think I talked about the three areas which are very important that they don't derail us, which is the conscience functions that I talked about. I think risk management is key. KRA area for the top management. We want to make sure that our compliance, risk and audit, that framework stays strong and gives us the right to grow, as I said. And that will of course be key. And that will be true for the entire team. Yeah.
Any thoughts on savings rate cut or introducing focusing sweep product? Sweep.
We do have a sweep product. In fact, we are focusing on the sweep product for our somebody asked so we are focusing on sweep product for our initiative as well. So we do have a sweep product and we will use it appropriately as we go along. Yeah. But we are not looking at a rate reduction. We can't pay lower than the top banks here and hope to gain market share. So we are not looking at any rate reductions on the savings side at least.
Many private banks actually have off-balance sheet risk to generate fees. What is our approach here?
No, so we have identified, I thought in our presentation it was there as one of the bullet points which he probably didn't talk about, but it was there. Yeah, our ratio of non-fund based to fund based is relatively lower. We can do with a bit more of risk appetite there and do something more. We have to choose our products well there. We don't want to issue 10-year bank guarantees to earn that income, but we will be selective, but we will step this up. It is part of the plan. In fact, this is what I was telling when in my closing remarks. Every area we have gone into, I think there are opportunities to build. And that's what gives me the excitement that there is, all this build-up of fee, NIM, all this is not, there is no one silver bullet which solves it. It is a combination of hundreds of small things that you do which builds. And like I said, I'm really excited because we've been able to go into those and identify each of those areas, and we will make sure that execution builds it in a granular way up from where it is today.
Which one segment will be key to drive the next leg of growth? Any challenges to scale any particular segment for Federal?
No, the segments we mentioned are very clear. The SME, the four segments that we talked about, those are clearly the priority areas. Challenge, yes, pricing is always a challenge with some products. Home loan is a challenging product to grow. Just now, home loan seems the most challenging product to grow in volumes. But yeah, from time to time, of course, different products will have challenges. But just now, I think, given the share of market we have, I think if we execute well, I do see potential to grow in most areas.
How do you see credit costs in FY26, especially given the environment and the fact that we have 2x/3x PLCC growth in the last 2 years?
So let's keep guidance on that to a separate discussion. Today, we'll stick to 3-5-year strategy so that we don't get derailed into next quarter numbers and things like that.
Your views on the future of FedFina?
So like I said, the regulatory stance is not yet clear. Regulator is yet to come back. Let's see how it evolves. We have to wait and watch.
In ROA delta, which one would take relatively longer to achieve? Cost of deposits, yield or fee?
Fee is the tougher one to get, I think.
With that,
yeah,
we wrap up. Thank you. Thank you so much.
Thank you. Thank you so much. Thank you. Thank you.